Hey, I'm Ben from Modern Graham, and today we are going to do a Modern Graham valuation of Archer Daniels Midland Company. So be sure to stick around to see what I think of this company. So we've got Archer Daniels Midland Company. This one has the ticker ADM. The current price is $75.33. The sector is consumer defensive. The industry is consumer packaged goods. And here we have the items from the balance sheet that I find most important. We have total current assets, total current liabilities, long-term debt, total assets, intangible assets, total liabilities, and shares outstanding. And all of these figures will play into the valuation. Over here, we have a chart that shows the earnings per share diluted in blue and the dividends per share in red. This one is a strong dividend company. If you were not already aware of that, that is one thing to look forward to here. We've got a lot of solid earnings growth overall. We do have some ups and downs in that. So what do we do about the ups and downs of the business cycle? Well, we take earnings down here. We can see that we've got all the detail here, and we normalize them by putting them through a weighted average. And that's what EPSMG stands for, earnings per share Modern Graham. What it is a weighted average of the last 5 years of earnings, with the most weight on the current year and the least weight 5 years ago. And with that, we can smooth out some of the ups and downs. For example, in 2012, you can see that earnings dipped from $313 in 2011 to $184 in 2012. That is a pretty big swing there. But on the weighted average side, we saw it go down a little bit, but not too much. So it kind of smooths that out, and it helps you see the overall trend in earnings a bit better. And you can see that that has really been on the rise. Currently, the estimate for this next fiscal year is 586, which is considerably higher than 20 years ago. We were at 0.63 for this one. So that is a huge growth on Archer Daniels Midland. So now looking at dividends, you can see that that stock price has gone up, but also the dividend has gone way up too. 20 years ago, it was only 24 cents per year. Now it is $1.60 per year per share. That is solid dividend growth, and it has continued every year. We'll see later how many years of dividend growth this company has, but you can see it has been steady. And that dividend yield currently is only 1.72%, but that does fluctuate between about 2 and 3% in general. And it has been a little bit lower than that in the past, but that does get pretty high. Dividend ratio, the dividend payout ratio, has been kind of fluctuating as well. That's because this company really devotes their they have a high what's the word I'm looking for? The high value on their dividend. So they want to make sure that they are steadily growing that. That is a value that the company holds that they want to give back to their shareholders through their dividends. And they want to grow that. So even on the years that the earnings dip, I bet in 2019, yeah, look at that. Earnings dipped from $319 in 2018 to $244 in 2019. But what did the company do? They didn't cut that dividend payout ratio, where they didn't keep the payout ratio steady. They still grew that dividend, and that is really good to see. You want to see companies that grow their dividend. It's very good for investing. Moving on, stage 1. Is this company suitable for the defensive investor or the enterprising investor? And remember, the defensive investor is somebody who's not willing to do a lot of research into individual companies, so they have very strict requirements of what they will accept in order to invest. The enterprising investor is willing to do further research, and so they have a little bit less stringent. But let's take a look. For the defensive investor, they have to pass 6 out of the following 7 tests. First up, we have the size of the company, and that has to be over $2 billion in market cap. It easily passes that at $41 billion. Current ratio has to be over 2. It fails that. Current ratio here is only 1.51. Earnings stability, it has to have positive earnings for 10 straight years. It passes that. It has to have dividend payments for 10 years. Well, we know it passes that. Earnings growth, it has to grow more than a third in 10 years, looking at 3-year averages at the beginning and end, and it has surpassed that growth level as well. The price to earnings ratio has to be below 20. Here it is 12.85, so we pass that. And the price to book ratio has to be below 2.5. Here it is 1.65, so it passes that requirement. So if you've been keeping score, we are at 6, and that is suitable for the defensive investor. Now, because it is suitable for the defensive investor, it is automatically suitable for the enterprising investor. But let's take a look at those tests anyway. So the enterprising investor has 5 tests, and it has to pass 4 of those or be suitable for defensive investors like it is here. But anyway, the current ratio has to be over 1.5, and it I'm not sure why this is showing as fail, but I will fix that as well. But and then here we have debt to net current assets. It has to be less than 1.1. It is here. Positive earnings per share for 5 years. Pass that. Pays a dividend. Passes that. And it has grown its earnings in 5 years, so it passes that as well. And so even if it were not suitable for the defensive investor, it would be suitable for the enterprising investor. Now, if you are enjoying this video, please take a moment to like the video, subscribe to the channel, and download the free valuation calculator. And by the way, these are just some things that people have said about my products that I provide. So you can check out those testimonials if you pause right now. But anyway, stage 2. Determination of intrinsic value. We take the modern Graham value formula. This is a formula taken from Benjamin Graham's book, The Intelligent Investor. And in there, he gave the formula value equals earnings per share times 8.5 plus 2 times the growth rate. What I've done is I have plugged in the weighted average normalized earnings there to get a modern version of this, to also incorporate another lesson from Benjamin Graham, which is to use normalized earnings. So here we have value equals earnings per share modern Graham times 8.5 plus 2 times the growth rate. And looking at that, we have 2 variables. We have the earnings and we have the growth. So let's calculate those. And again, that is a weighted average of the 5 years of earnings. We get 5.86 for the current year. So we take that and we put that in for the current year, and then we take the figure from 5 years ago at 271, and we calculate total growth and divide that by 5 for an average growth of 23.29%. Now, this is a good time to have a safety margin in there, because if you overestimate growth, you have a huge impact on that value. And so we lower that growth estimate right there to 17.47, but that's not enough, because this is growth in perpetuity, and it doesn't make sense that any company would grow in perpetuity so much that it would be over 15%. So we've put a mandatory cap there at 15%, and that is being applied here. Putting that into the formula, you get earnings of 586 and the growth of 15%. You get a value of 225.74. Now, that would indicate that the company is only trading at about a third of its value. So it gets an undervalued rating from that. But you can go a few steps further here. If you bring that growth down to 3%, then that would be an 85.02 value, and that is still higher than the current price. Now, that would be closer to a fair value rating in the system. And if you were to assume that 0 growth going forward, you would get a value of 49.84. And if you plug in the price, the market price right now, in for the value and then solve for growth, you can determine that the market is implying a growth of 2.17%. So another way of looking at this would be, if you think the company will grow more than that in perpetuity, then this would be an undervalued company. If you think it would grow less than that, it would be an overvalued company. So again, it's another way of looking at that. Coming down here to the modern Graham grade. This is another way of looking at a company. so that you can compare it across industries. It applies scores and brings in more factors than just that valuation calculation. So, investor suitability, it gets 2 points for being suitable for the defensive investor. It gets 1 point for being undervalued. It gets 1 point for trading below its Graham number, which we'll talk about more in a moment. It gets 1 point for long term dividend growth, half a point for having a dividend yield above 2%, and half a point for trading below its industry average PEMG for a total score of 6. And that is off the charts. It is an A+ grade for this company. Moving on to stage 3, further research. Now, the net current asset value, that should be a floor to your price because that is a liquidation value. If a company is trading below that, then shareholders could go in and they could buy up the company, or they could force the company to pay off all of its debts with its cash. And then the cash that would be left over is what could be distributed. And that doesn't even take into account the actual real estate of the company or any other long-term assets rather than just the current assets. So that is something to keep in mind. The Graham number formula, this is a calculation based on those defensive investor requirements. It's a way to put a number on those to more easily look at a company. And here we have a Graham number of 83.55, which is higher than the current price of 75.33, so it is trading below that Graham number. It could be another indicator that this is an undervalued company. And again, the price to earnings ratio is 12.85. We're using the weighted average earnings for this to get the price to earnings modern Graham. Then the current ratio is 1.51. The PB ratio, price to book, is 1.65. The dividend yield is 2.19%. And it has had a 47 years straight of raising that dividend. So this is definitely a dividend aristocrat. And here's some other things that might be useful for you. The 10-year share buyback ratio is 1.9. The 5-year share buyback ratio is 0.3. And the 1-year is 3.2. So they are currently buying a little bit more shares than they have recently. There have been no insider buys the past 3 months. So those are things to look at. Now moving on to stage 4. We want to look at the chart, and you never want to, here, let me switch to daily view actually. You never want to look at the chart for valuation purposes, but it can be useful once you've gotten to the point that you've determined that it is suitable for your investor type, defensive or enterprising, and then you've determined that it is undervalued, and you've determined that it is suitable for your individual portfolio. That's stage 3, by the way. Then you get to stage 4. You want to try to get a good buying opportunity to maximize your profits. And that is when technical analysis can be useful, because you can look at what the market is doing to try to get that timing just a tiny bit better. You can never time the market perfect. So you could be wrong. I could be wrong when I'm looking at charts. It happens. But it can be useful to trying to get that just one step further. And so looking at the daily view, you can see that it has been going down. That's why it has become undervalued. But you can also see this here is the relative strength index. And right now, purple is where the current figure for that. And if it goes below this dotted line that I've put on here, then it is below a 30 value. And then it would seem to be oversold. These are then moving averages. And you can see, looking at this right now, that there is a little bit more downward pressure because that red moving average is coming down. And it's not heading back up yet, but this purple one, the current value, is starting to come back up. So I would anticipate that it is flattening out. Then we also have a doji candle here, which indicates that the downward trend might be ending soon because there's starting to be more upward pressure from buyers, and so it is starting to slow down. You can see that there too. Then if we come down here, this is the Bollinger Band width, and the Bollinger Bands are these darker green ones. And you can see they tighten up when the market consolidates a bit, and then they expand when there's big movement. You can see that here. It consolidated through this period, and then it got a bit tighter, and then it expanded as it went down. And the same thing is happening. And you can see right now, this is just calculating the width of that mark. And when it starts to go down, what I like to do when it tightens up there is I look to see whether or not there's upward or downward pressure. And here there is more likely to be upward pressure. So I would expect that it would go up when it opens up. And it did a little bit, but overall there was still pressure going down. But then it did come back up there, and then it came back down. So that is one thing to look at. And all of these things put together can be useful. I would anticipate at this point that it is consolidating. And you can see it consolidating around this support level here. And it may end up going up. And if it does, then that would be a really good sign. But yeah, those are things to look for. And be sure to click on the video on the screen now. It will be another valuation that you will enjoy. And as always, thanks for watching, and I will catch you next time. Take care.